Good morning and welcome to the K3 Capital Group PLC full year results investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time via the Q&A tab that's just situated on the right-hand corner of your screen. Please just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all of the questions submitted today and publish responses where it is appropriate to do so. Before we begin, I would like to submit the following poll, and if you could give that your kind attention, I'm sure the company would be most grateful. And I'd now like to hand you over to CEO John Rigby. Good morning, sir.
Yeah, good morning, everybody, and thanks for coming on to listen today. We are, I guess, delighted to be talking to you this morning about the performance of the K3 business, which I think through these results is hopefully proving that the diversification and the resilience that we've built into the group is allowing it to flourish regardless of that wider macroeconomic turmoil that we're certainly seeing at the minute. So the significant growth that we will talk to you about today has been achieved, as we all know, against the backdrop of Brexit, a pandemic, a war, considerable turmoil across energy markets, supply chain, staff and recruitment. And I think what we're proving is that this is a high quality group of businesses that we are building that can perform so well in the face of such difficult market conditions. I think really just underlines the quality of what we have here as K3. So conscious that we have a mixed audience, I guess, of those that probably know us reasonably well and those that perhaps don't. So the first couple of slides really are just to introduce and tell you a little bit more about the group and the trajectory that we're on. So, you know, what is K3 these days? It's changed significantly over the last couple of years. It's now a group of diversified businesses that service UK SMEs with specialist advice across three divisions, those being business sales, tax, and restructuring and insolvency. What we do differently, I think, than most advisory businesses is that we use data, we use proprietary technology platforms that we've built alongside systemized processes and our experienced teams of people across the divisions to help entrepreneurs to firstly sell their businesses and create capital value, to secondly to optimize their tax arrangements, and thirdly, to provide them restructuring and insolvency advice in those more difficult times. We do this at volume. So who do we help? We help thousands of SME businesses each year across the three divisions. And as a measure of that, we invoiced over 9,000 clients in the FY22 period. We have an exceptionally strong track record of growth. And in the FY19 to FY22 periods, we've got a very impressive 72% compound annual growth rate in our revenue and a 60% compound annual growth rate in our EBITDA. And that revenue that you see there of 70.7 million to May 22 has been delivered by record performance across each of those three divisions. So we're delighted to see all three divisions contributing exceptionally well to that success. Our ambition as a business, which we first stated 2 years ago when in September 20, so two years from today pretty much, we were delivering a profit number of 6.8 million EBITDA for FY20. And our ambition stated at that point was to build to short-term target of 25 million EBITDA and a mid-term target of 50 million EBITDA. And we feel very much that our strategy of organic growth driven by our unique client acquisition strategies, a proven acquisition blueprint and launching new and complementary service lines that sit very well alongside and within our existing brands, that is seeing us well on track to deliver on that very ambition. Over the page, a bit more detail around the group and the different brands that sit within the group. So firstly, if we look at the left-hand side, business sales, we go to market within the business sales division under different brands, subject to the enterprise value and or the sector of the client's business that we're looking at. We are and we remain the UK's #1 sell-side advisor by deal volume. So since 2017, we've completed more sell-side advisory mandates than any other advisor in the UK. And we do that because this is a volume play fueled by a very proactive data and marketing driven platform, which targets both sellers and buyers in a systematic, process-driven way, creating what we would term a factory of SME business sale transactions. We've recently added 3 new service lines to the business sales division. So debt advisory, transaction services or due diligence, and a buy-side business called Market Mapping, in which we have a joint venture, which are all being fueled by the cross-sell piece across the group as a whole. Business sales is a high margin division. As you can see there, we typically operate around the 50% margin, and we're delighted to report 10.8 million of EBITDA from the 21.6 million of revenue that was achieved in the period. As I said earlier, a record performance. We have about 175 people in that part of the business, predominantly operating through one main office up in the northwest. And our market share we estimate to be under 5%. So a highly fragmented market and lots of opportunity for market share gain and growth within that division, and which is certainly something that we've done in a sustained way over many, many years, and we'll show you some graphs on that shortly. In the middle, the tax division, we have 4 brands in total, but around 90%, I would say, of those revenues come from the 2 brands at the top there, which are our research and development brands, Rand and Knight. They operate in the research and development tax reclaim arena, and what that gives the group, and the reason we acquired into that sector in the first place, is that it gives the group high quality revenue and earnings due to the contracted and therefore recurring nature of the client revenues within those brands. And again, we'll show you some stats on that shortly. We also have a tax investigations business called Intax, and we launched earlier last year K3 Tax Advisory, which is growing well again and enjoying strong cross-sell within the wider group. Again, it's a very high margin part of our business, again typically targeting 50%, and this year actually delivered slightly over that, a 51% margin, so almost 6 million of EBITDA in the period. Around 60 staff, again operating out of one main office in Derby and 2 further smaller offices. And market share wise, we would estimate to be sub 2% of that market. So again, a highly fragmented market with lots of opportunity for growth as we look forward. Finally, on the right, Quantima, which is our national and in fact now international restructuring insolvency brand, a top 3 independent player in the UK insolvency market based upon volume. It provides the group clearly with counter-cyclical revenues. It's grown significantly from when it was formed in 2013, so typically delivering 30% plus compound annual growth rate. It's diversified into forensic accounting, into corporate finance. A number of small bolt-on acquisitions and lateral hires have seen considerable growth be driven over that period. And we're very excited about the continuing growth opportunity that the division brings us. Margins in that division very different, typically runs at approaching 20% in what is a more people-intensive, people-driven, time-charged environment, so more akin to a normal professional services business, but delivering 6.7 million of EBITDA in the period. About 330 staff currently within the Quantima brands across 17 offices in the UK, 6 offices overseas, which we'll come on to shortly, and a market share of between 4 and 5%. Okay, over the page, we wanted to talk to you a little bit about the market that we service and the fact that that UK SME market is in fact a structurally growing market. So if we look at the number of SMEs, top left-hand graph, over the past 20 years in the UK, and these are government statistics, we see that there are now 6 million SMEs within the UK, up significantly from 3.5 million 20 years ago. So that really, I think, underlines the opportunity that servicing UK SMEs provides to the group. And just to move then on to the individual divisions, I wanted to talk to you about the resilience of those businesses. I think, as I said right at the start, I think the business is proving through its performance the resilience that it has built into it. But just to talk to you about that in a little more detail. Firstly, on business sales, as I mentioned, it's a very proactive, data-driven marketing platform that creates the activity for us in terms of both sellers and indeed sourcing buyers for those sellers. We believe that our clients are often motivated by personal reasons, very different than the sort of global M&A trends that you might see. And again, I think that's borne out by our figures, but our clients are selling due to many and varied reasons, but often personal reasons such as health, divorce, retirement, or wanting to realise capital value out of the asset and the business that they've built. As I said, it's a volume play. We are the UK's leading advisor by deal volume, and consistently ranked number one on that basis. And that gives us a certain hedge in that we cover all sectors, all geographies. We sell for all types of sellers, and we sell to all types of buyers. And if you can just flick onto the graph on the next page, I think this hopefully highlights that resilience that we've built into the business. What you see here in the grey bars is the total number of transactions. These are statistics drawn from Zephyr. The total number of transactions that happen in the UK each year. These are reported transactions. And what you see is that the market fluctuates between, actually doesn't fluctuate very much, but between sort of 2,600 in a relatively slow year, up to around 3,400 in a strong year. But typically, and certainly over the last 10 years or so, the fluctuations have been up or down by 10% on an annual basis. So the market is relatively stable regardless of the wider macro, I guess is what we're saying there. What we're also saying with the blue line is that what you see is that K3 as a business, and this purely plots the business sales revenues of the 3 heritage brands that we had. So this isn't including any of the acquisitions or diversification. This is purely like-for-like comparison. You see a business that's grown from just over 2 million of revenue to just under 20 million of revenue through those 3 brands. So a 700% plus increase in revenue during a period where the market has been relatively flat and relatively benign. So what is that saying? That is saying that our approach, our proactive approach, the way we utilize data and our proprietary technology to drive activity, to win market share, is growing our business despite whatever influences the wider macro might be having. If we just go back up, Andy, to the previous page and look at the tax division, the very reason we invested into tax and specifically research and development tax credits in the summer of 20 and again in the summer of 21 was because we saw an opportunity to bring high quality contracted and recurring revenues into the group. We also saw an opportunity that we could accelerate those businesses through applying some of that methodology that I've just talked about that we've used for many years in business sales to drive the growth of client numbers within the tax division. And if you flick down to the graphs on tax, what we see is that within both our RAND business and our Night business, all of our clients are coming to us. All of that revenue is being generated through contracts. So all of those clients in RAND typically are contracted for 5 tax years, and in Night typically 3 or 5 tax years. And what we see is all of that revenue. So there's 6 million of revenue in RAND. 70% of it came through clients that were contracted to us prior to the start of the year, and 30% of it came from clients that we contracted during the year. But the entire £6 million of revenue is now contracted and therefore recurring to a degree. In Night, the same story, 3.8 million of revenue, 77% contracted ahead of the financial year, 23% of it contracted during the financial year. Our K3 tax advisory business and our in-tax business over on the right-hand side are more sort of transactional one-off revenues. So that isn't contracted revenue. But if we look at the division as an overall, 11.6 million of revenue, of which 84% of it is typically on 3 or more often 5-year contracts with our clients. So the tax division gives us sticky contracted recurring revenues that will happen again and again, year in, year out. The key to us then is growing client numbers within those 2 businesses. And as I mentioned, by plugging that business into our data and technology platform, we are seeing an ability to accelerate the growth in client numbers. And to give you a statistic, we are almost 40% up on client numbers as I stand here today than we were this point 12 months ago. So you see a significant acceleration in client numbers, all of whom are typically on these 5 tax year contracts. And if you back up to restructuring, that's great. So very similar to tax, the reason that we invested into the restructuring and solvency sector back in the summer of 20 is that quite clearly it provides the group with counter-cyclical revenues. So Quantuma itself, very strong in the UK insolvency market, but has also diversified into forensic accounting, asset tracing, and corporate finance services. And more recently, we have continued with the build out of its international footprint. So when we acquired the business, it had offices in Cyprus, and it now has operations in the Cayman Islands, the British Virgin Islands, Singapore, Dubai, and a small forensics office in Poland. And what we are therefore seeing is an opportunity to have multiple building blocks in growing out that Quantuma brand. So whether that be international, UK, forensics or corporate finance, there are multiple building blocks in terms of the quite significant growth that we're seeing in Quantuma. And if you just pass to the graph on the statistics. So again, what we show you here in the top graph is the size of the insolvency market. These are insolvency volumes over the last 20 years. And you see that they fluctuate between probably 15,000 as a low point typically through to approaching 25,000 back in 2009, with an average, as the red dotted line, about 17,500 corporate insolvencies per year. What you see then during 2020 and 21, because of the widely reported government support and changes to legislative changes in various areas, that number fell off considerably. So that tidal wave of insolvency that everybody was talking about in the spring and summer of 20, as we all know, never materialized. What we are seeing now in 2022, if we look at the statistics, and that is a 7-month number extrapolated out to 12 months, we are seeing that market is returning to and beyond pre-pandemic levels, and potentially up to sort of record levels of corporate distress within UK SME. What's really pleasing for us is that Quantuma has been able to grow its market share despite that relatively challenging market. And if we just look at revenue growth in the last 12 months, 45% growth on the revenue line in a market that has been pretty much at its worst of the last 20 years, I think is testament to the quality of the Quantuma operation and the business that we brought into the K3 Group back in the summer of 20. Okay, over on page 9, we wanted to talk to you a little bit about, you'll hear me talk about our data and marketing platforms, and we have a number of those. So we just wanted to touch on that and what some would refer to as our special sauce, and why we are different and why we are driving organic growth rates that are well above our peer group. The data sources on the left-hand side are available to anybody ultimately, and we gain multiple feeds of data from multiple sources to help drive volumes of data into our database. We have 6 full-time data engineers that work on that data set in terms of improving it, cleansing it, profiling it, and cutting that data to provide marketing campaigns into our various brands. In all, there are over 150 million data points within that data set. This is a significant piece of data. We've been optimizing and growing that data set for over 10 years. And just to give you a flavor, it includes data on over 6.2 million entities, 13.3 million shareholders, and contains information around 118,000 historical transactions that have occurred in the world of M&A. All of that data then feeds into the platforms that we have, all of which are proprietary. It started with KBS Globe, which is our system within the business sales division. And that system drives all of our marketing and client acquisition activity and drives essentially all of our revenue within the business sales division. What we were able to do, and part of our strategy as to why we acquired into other SME-focused sectors, was we are able to duplicate that software and create an opportunity for those businesses to leverage the value of that software and that data into those other brands. So our first foray was Rand Globe, which we created back in Q3 of FY21. And what we saw is that started to accelerate those client wins within Rand. And as I just touched on before, we have 40% more clients in our tax division now than we had 12 months ago. And a significant number of those clients are coming through utilizing that technology and that data asset to drive growth within the tax business. More recently, we've created Quantuma Globe, and we are trialing a process of marketing the Quantuma brand directly into SMEs who quite clearly are coming under and due to come under significantly more pressure over the next 6 to 12 months. So we believe there is an opportunity there to harness that data and that technology asset across the restructuring division as well. The other piece of technology that we have, BME, is quite simply our buyer matching engine, and we utilize that to drive the buyer activity within the business sales division. So that essentially automates the process of contacting and matching buyer with seller, and creating a significant uplift in the amount of buyer activity that we see in terms of NDAs, buyer meetings, offers, and ultimately transactions. So very differently than most, we are using data and technology to drive growth across our business, rather than, which is more common in professional services, referrals and reciprocity, and seminars and webinars and that sort of thing. And just finally, before we finish on that, I think what is particularly clever about our data and what gives us that unique edge is that every interaction that we have with an SME or an SME shareholder, we collate and gather further and more and better information. So as an example, we are making almost 100,000 phone calls per month out of our business. And each of those phone calls is an opportunity for us to gather further information around those businesses in terms of their preferences, their requirements, contact information, phone numbers, email addresses, when might they wish to sell, what are the reasons behind that, what might they like to buy, in what sectors, at what price point, etc. So it's that self-generated data that we add into that database on a daily, weekly, monthly basis, and we have done for many, many years, that really gives us, I think, that unique edge over many in our market. And we'll come on now to talk about the organic growth that we're achieving within the business and the part that plays within it. So yeah, if we consider our peer group and others within professional services, most of them would be delighted, I think, with a 10% organic growth rate. We see many at single-digit organic growth as the norm, and whereas with ourselves, we've achieved 24% organic growth across our group this year. Why? I think because we can harness the power of these client acquisition strategies across the businesses and the brands within the group. So just to touch on those, so Globe, we've just talked about there. It's a leading SME data set, in my opinion. It's a proprietary marketing platform. It generates almost 100% of the revenue that you see within the business sales division, which, as you saw from the graph previously, has grown and grown and grown year in, year out, despite the wider macro. What it's now doing is it's starting to influence as well through Rand Globe, the growth of the Rand business within the tax division. So initially in FY21, when we introduced it, I think it generated 1% of revenues that year. Last year, it generated 13% of revenues. So far this year, it's responsible for around 3/4 of the new client wins that are coming into that Rand business. So utilizing that data asset and technology to drive organic growth and client acquisition in our businesses. Moving to the second area, K3 Hub, we've talked before about our referrer network that we're building, which is made up of typically small to medium-sized accountants or professional advisors that don't have within their organisation restructuring, tax, or corporate finance and business sales expertise. So they are able to refer those clients to us, and where appropriate, we can pay a fee share or a commission back to them for doing so. We have over 2,000 members of that network now across over 1,000 firms. Last year alone, we hosted 24 webinars, which is an opportunity for us to provide CPD training to those advisors, and also to promote our brands and our businesses and our offerings across those advisors and ultimately into their clients. Last year, we delivered around 2.5 million of additional revenue from referrals that came from that K3 Hub platform. Moving down to cross-sell, clearly because all of our businesses are focused at UK SME predominantly, there is a great opportunity for us to cross-sell clients, to bundle products together, and for clients to use different elements of the group subject to where they are in their cycle. Again, as a statistic, approaching £2 million worth of revenue last year generated from that cross-selling activity. And it's my belief that is only just scratching the surface in terms of the art of the possible and what could potentially come from that area. But it's that SME focus that allows us to do that and pass clients within the group. Fourthly, we're expanding our footprint. As I sort of touched on or alluded to earlier, specifically within the restructuring business, we have made investments and hired individuals and opened offices in some key international locations in terms of that that wider restructuring insolvency market. So offices in Cayman, BVI, Singapore, Dubai and Poland have all been funded, and whilst they have created a small drag on EBITDA in the period, we are investing for the future and the medium to longer term growth of that division. And lastly, the launch of complementary service lines. So K3 tax advisory as a prime example, but also within debt advisory and transaction services due diligence, we've launched new businesses that are benefiting from and growing from the capability of the group to feed them with cross-sell and referral. So, in summary, rolling out and optimizing those client acquisition strategies across multiple brands is driving strong double-digit growth in all areas of the business. So business sales has grown 25% organically in the period, tax 35% organically, and restructuring 21% organically. So giving us a blended 24% organic growth, which is, as I mentioned earlier, is very much at the forefront of our sector and indeed business growth in general. Over the page, Andy, is the other area of growth that we've seen over the last few years, which is through acquisitions, and this very much still remains part of our strategy looking forward. And I think we've proven over the last 2 years that we are able to acquire businesses in off-market situations, often for very realistic multiples and structures that are therefore highly accretive to K3 as a business. I think as important as that, we're also proving that we can then be additive to those businesses through supporting them with both enhanced distribution, as I talked about, plugging them into those distribution platforms that we have, but also helping to centralize functions and allow the leadership teams, the senior people within those businesses to focus on strategy, to focus on growth, rather than other functions such as finance, HR, IT, data, etc. We continue to source, to meet, to consider acquisitions on an ongoing basis, but very much with a view to only buy what is right for us, rather than buying simply to engineer growth. Characteristics-wise, what are we looking for? The key thing is businesses that can grow, businesses that are SME focused like we are, businesses that we can improve and can become better by being part of K3 and can grow quicker by being part of K3, by us helping with those centralized functions and then enhancing their distribution and their client acquisition capabilities. I think that's probably best articulated through the post-acquisition growth that we've seen across some of the acquisitions that we've made today. So if we look at Rand, revenues have grown by 38% in the 2 financial years since we've acquired it. In Quantum, revenues have grown by 76% in the 2 financial years since we've acquired. Knight Corporate Finance has grown by 54%, with growth in the core business plus the launch of transaction services, and Knight R&D has grown by 23%. So I think very much underlining that fact of helping businesses to grow and be better as part of K3 rather than as an independently owned and run business. I touched on there sort of supporting those acquisitions centrally, and this is work in progress, but we are building out our central functions to be able to support those businesses going forward, and also other businesses that will no doubt join the group as we look ahead. So that involves things like building a central finance team up at head office in Bolton, which can then provide timely accounting and management information across all of those businesses. It's looking to build out the HR function of the group, so software in place now across the entire group, but building out the senior HR team to help us look forward in terms of bringing talent into the business, retaining talent within the business, and developing the leadership of the future. From an IT and systems point of view, it's around us trying to bring harmony across the systems and the IT that we have across the group, such that we hopefully create value in those providers, but we also create a commonality and a robustness across how we deal with IT and systems across the 14 brands that we now have. And as we've already touched on there, how we leverage our data assets, how we leverage our sales and marketing know-how and our platforms to be able to drive growth across those businesses. So I think, as we talk to acquisitions, we become quite a compelling home for them to want to join and become part of this story that we're creating here at K3. Okay, over onto group highlights. So we're going to talk to you about the group, and then we'll break down into the individual divisions and just give you a bit more data around the divisions. But from a group point of view, as I mentioned earlier, we are delighted to be announcing another set of very strong results, which are again ahead of market expectations, very much as they were last year. This is a broad, a diversified, a resilient group of businesses now, and I think no better displayed by that 70+ million of revenue coming from 9,000 invoices at an average value of around £8,000. It really underlines the strength in depth and the quality of earnings that we have within K3. As I touched on the previous slide, we've seen double-digit organic growth across all divisions. So this isn't one division in particular. This is all divisions performing strongly and delivering double-digit organic growth through that differentiated client acquisition offering that we bring to the table. In addition to that organic growth, we've successfully integrated and also then achieved strong growth in the acquisitions that we've made, alongside which we've also launched the new service lines that I touched on, all of which are growing well, enjoying strong cross-selling, and now starting to really contribute towards revenue and EBITDA. From a dividend perspective, our progressive dividend policy continues to reward shareholders. So we see a 33% increase in dividends in the year, from 9.1 pence last year to 12.1 pence this year. And finally, I guess with record transaction pipelines in the business sales division, with growing client numbers, with that contracted and recurring nature of those revenues in the tax division, and with increasing demand that is widely reported in the restructuring insolvency space, we would again aim to deliver and potentially over-deliver on market expectations for FY23. I'll just let Andy give you a bit more detail on the financials.
Yes, group financial highlights. Delighted once again to report on another year of significant growth. Revenue up by 50% to £70.7 million and adjusted EBITDA up by 30% to £20.4 million. Quite pleasing to show that in addition to complementing our acquisitions, we still see significant and what we believe to be industry-leading organic growth with 24% in the period. Cash balances, we finished the year on £13.7 million. When we made the strategic acquisitions back in 2020, we set out an internal challenge to be broadly cash neutral over the period of the earn-out, whilst maintaining our progressive dividend policy and, of course, paying the earn-out payments over a period of time. Therefore, to finish on £13.7 million after paying dividends of £7.4 million and earn-out payments of £3.2 million, that is broadly cash neutral and exactly where we expect it to be. The dividends, as John's touched on, we've set out now a progressive and fixed dividend policy to give shareholders visibility and certainty of returns. That increases from 9.1p in the prior year to 12.1p, subject to voting at the AGM next month. And we're committed to the 15.5p in FY23 and beyond. Adjusted EBITDA margin finishing the year on 29%. I think we've set out historic targets in terms of business sales to be around 50%, in our tax division around 50%, and our target to be around 20% in restructuring. There has been an investment into overseas offices within restructuring that sees a slight drag this year that we'll talk about a little bit later on, but still to be at 29%, a very strong margin. Finally, on this page, we've talked about earnings enhancing and accretive acquisitions. Clearly, at the start of the year, we had a £10 million fundraise to make the Knight acquisitions. So even after that dilution of shares, we still see adjusted earnings per share increasing by 11% to 20.64p in the year. Over the page, we've just detailed a revenue bridge that shows the growth on prior year. 47.2 million in the prior year. There's been a 35% growth in the business sales division. Part of that has been the acquisition of Knight Corporate Finance with historic revenues of £1.7 million. As we've touched on, 25% organic revenue growth from the original KBS group and also from the addition of K3 Debt Advisory. Quite significant increase in tax, 123%. Clearly, a large element of that has come from the acquisition of Knight R&D that had historic revenues of £2.9 million. We've also launched K3 Tax Advisory and grown the RAND business, as we've talked about. So again, we think quite an impressive 35% organic growth. Finally, in terms of restructuring, 45% growth of £11.6 million. Obviously, in the prior year, there was 10 months as opposed to 12 months Even when we prorate that, that still shows a 21% organic revenue growth, and that's in addition to our overseas office expansion and also our investments into fee earners in the period. Over the page, we just detail the profit bridge, again growing from the 15.7 that we delivered last year, a £2.4 million increase in business sales. Obviously, there was the acquisition of Knight that brought around £1 million of EBITDA. We have grown the rest of the business as well, so significant organic growth. The tax division, we see £2.8 million worth of growth in revenue. Rand, I think it's fair to say, has seen significant growth in revenue, whilst at the same time we've invested into the direct marketing machine that John's talked about. In FY21, around 1% of revenues came from that direct marketing engine, increased into 13% in FY22, and really pleased to see that in Q1 of this year, just over 75% of new client wins have come from that direct marketing engine. So whilst it takes time to implement, and there was a slight drag on margin, still significant increase in profitability from that division. In terms of restructuring, 0.7 million increase. I think as we've touched on, in the period we've set up offices in BVI, in Cayman, in Dubai and in Singapore. That's seen around £500,000 drag on EBITDA in the period that we would expect to move into profit in the future. We've also invested in our headcount of fee earners from 225 to 250. Again, building capacity ahead of the return in the market, but still to deliver growth we're pleased with. Finally on this, there has been an increase in PLC costs in the period. We've talked about the strengthening of the senior management team, bringing in people like a group managing director. We've got a centralised finance function now up here in Bolton with a group finance director, acquisitions director and such like. We feel now we've got a strong platform to deliver on this growth and can't anticipate any more step changes. All of that leads us to the 20.4 million adjusted EBITDA that we've presented this week. Handing back to John on divisional reporting.
Yeah, so just to give you some highlights and some breakdown in the financials into each division. So if we look at business sales first of all, it's been a record year. We've mandated more sellers, we've sourced more buyers, we've completed more transactions than we ever have done before, which is great to say. And that leads to the highest ever divisional revenue, so 21.6 million, which is 35% up on previous year. That 25% organic growth that we've talked about is complemented then by the acquisition of Knight CF earlier in the year, which has continued to grow as part of K3. And alongside of that, the launch of Knight Transaction Services, which again has seen a strong year one from a standing start and partly fueled by cross-sell within the group. Quality of earnings within the division, we believe, is very strong. So over 90% of revenues come from the volume brands of the business. So delivering, hundreds and hundreds of transactions on an annual basis, which give us good forward-facing visibility, rather than the larger, lumpier corporate finance transactions that have been a key part of our revenues before. So those numbers or those revenues now very much providing upside opportunity rather than downside risk. And as we start to look away from 22 and look forward to FY23, our business is very much continuing that momentum that it saw in 22. As an example of that, despite a very strong Q1, we have record transaction fee pipelines as we move into Q2 and the rest of the year. So whilst completing more and more transactions, we are agreeing and putting into our pipelines more than we're taking out at the bottom. So that gives us strong confidence and visibility of sort of that pre-revenue pipeline, if you like.
Over the page, we've got some key statistics in terms of profitability of the business. Those who've followed us since 2017 will know we use the word record quite often. Business sales revenue up by 35% to £21.6 million. This is a year of significant growth within this division, with record levels of transactions, whilst maintaining our pipelines as well, as John said. Our business sales EBITDA increasing by 30% from to £10.8 million. And again, just to underline that 25% organic revenue growth. We've put two graphs into the bottom that just track mandates and completions. So again, we believe this illustrates the strength of the markets in which we operate. Year-on-year increases from the core business. This is from the KBS group of companies. a 53% increase. So more sellers coming to the market than ever before because of our direct marketing engine really driving activity levels. On the other side of that business, in terms of transactions, even more successful in terms of being 56% up on the number of transactions we've completed. We're seeing more activity than ever before, and they're receiving over 4,000 NDAs for our clients every single month. And again, topping those league tables, industry league tables, in terms of the volume of transactions that we complete on a regular basis.
Okay, that's just which is in the presentation deck, some of the data around the league tables through PitchBook, Refinitiv, etc., which I'm sure everyone can look at. But as we've said before, number one advisor in the UK for some years now. Move on to the tax division. 2 years ago, we didn't have a tax division, and now we have a tax division that has revenues of 11.6 million and EBITDA approaching 6 million. So significant growth in the strength, in the scale, in the depth of our tax business during both FY21 and FY22. In the period, we've seen 123% revenue growth, 35% organic revenue growth. So significant acceleration of the growth of that division within the K3 Group. Acquisition of Knight R&D has been a factor in broadening out that R&D offering, and the launch of K3 Tax Advisory brings further diversification. It keeps revenues which would previously have gone to third parties within the group, and that business is performing very well. We are, as I mentioned earlier, leveraging our data asset and our technology asset to help to drive client acquisition within the tax division. And as I mentioned, client numbers up almost 40% year on year, and all of those clients coming on 5-year tax contracts. Our R&D brands have submitted more claims than ever before to HMRC, and we maintain a 100% success rate on those claims, a 12% increase in claims submitted in the year. As we touched on, the tax advisory team is a particular success. It started with 2 people just over 12 months ago. We now have 8 people within that team, turned over £750,000 worth of revenue in year 1, fueled partly by cross-sell within the group, as our business sales colleagues and restructuring colleagues obviously have a requirement for that complementary service, and convinced that business will continue to grow very well as we look forward.
Just on one page, the key financials of the tax division. As we've touched upon, significant revenue growth, 123% to £11.6 million in the period, delivering a 90% increase in EBITDA to £5.9 million and maintaining that 50% plus EBITDA margin. Quite significant organic revenue growth there, 35%. Again, that's down to our direct marketing, this RAN Globe that's now delivering significant amounts of work into the division. At the bottom, we've just shown a breakdown of the number of R&D claims made in the UK year on year. I think to illustrate this is a growing industry, as there's ever-increasing awareness of the support that's available, that we're helping drive to SME owners by our direct marketing engine, some of which just are not aware that they are eligible for this support. To give people comfort, before we made this acquisition, or the acquisition of RAN back in 2020, we commissioned a company called GK Strategy to carry out quite a detailed political due diligence report. At the time, they spoke to ministers of all parties, many different backgrounds, many different areas within government and around shadow government. That was a very supportive report, no red flags whatsoever, and gave us great comfort in moving into this industry. Obviously, there's been quite a bit of recent turmoil that's been well publicised. We thought this was a good time to revisit that report. Around 6 weeks ago, we asked GK to update it. We got the results back last week, and again, they've spoken to a number of ministers across all parties. There's full support for this scheme in the UK. It was introduced by a Labour government many years ago. This or a similar scheme to this is operated across all developed nations across the world, and there is a consensus that any major changes to this risk pushing innovation outside of the UK, which clearly is not something that any political party wants. So we've got great comfort. This is a well-established scheme that operates across the globe, and a growing industry that will only continue to grow year on year.
Okay, finally, just to move on to the restructuring division. So a division that's grown very well in the period. So 45% revenue growth to 37.5 million, 21% organic revenue growth against the headwinds of a very difficult insolvency market over the last 2 years. So I think, again, as I said earlier, just underlining the strength of that consumer business, that it's been able to grow its revenue line so strongly in a relatively difficult market. That market headwind is now very much turning to tailwind as UK SMEs experience those difficulties, and the reported uptick in activity and the surge in demand certainly suggests growth for FY23 and beyond. And we've seen a similar increase and uptick in the number of insolvency appointments that Quantum have seen in Q1 of this year versus Q1 of last year. In light of that expectation of continuing and growing demand, we've seen continued investment into our headcounts, which sees us with operational capacity within the business to take advantage of that. So our staff numbers have grown to circa 330, and our fee earners have grown to around 250. As discussed earlier on in the presentation, and as we flagged at H1, we've seen investment in our overseas office network in the period. So key hires and office openings, providing us now with that international footprint to take advantage of some of that multi-jurisdictional, cross-border, often quite complex and potentially quite lucrative pieces of work. So we look forward to the growth in our international operation next year and beyond. And to give a flavour, in FY21, we did around 1 million of revenue from our international operations. Last year, it was approaching 3 million of revenue, and we would expect significant growth in that number as we look forward. So it isn't just the UK market and the uptick in activity that we're looking forward to being a growth driver. It's that international piece as well. Quantum, as I said earlier, it remains and is a top 3 independent player in the UK in terms of the volume of transactions that it handles. Currently has over 4,000 cases within its WIP. So again, this is a business, a brand built upon volume, just like our business sales division, just like our tax division. And in terms of growth looking forward, we continue to review acquisitions and lateral hires in terms of enhancing our national presence and complementing that organic growth story.
Again, some key statistics on this division. Just a reminder that when we acquired Consumer back in 2020, this was a good quality business that has seen over 30% compound annual growth rates in the 4 years prior to acquisition. So really pleased to see this 45% increase in revenue over the period. And again, we see this continuing going forwards. Q1 this year has seen a 36% increase in the number of appointments that we've won compared to the Q1 in the prior period. This is very much a business that's continued to grow despite the headwinds of the market around us. Restructuring EBITDA growing by 12% to £6.7 million. As we've touched upon, there's around a £500,000 drag there due to the investments into overseas offices, which we can see turning into profit moving into FY23 and beyond. And that's caused a slight drag on margin to 18%. We see this making its way back towards 20%, which has always been our long-term target. Ultimately, though, 21% organic revenue growth, we believe, is industry-leading, something that we're pleased with. We've achieved that, as John says, through the expansion of the geographical and fee earners that we've got. Offices being opened in BVI, Singapore, Dubai and Poland. In addition to that increase in fee earners from 225 to 250, really building capacity as the market starts to return. At the bottom, we've just put in a bit of 2 charts to show a little bit more detail on Consumer specifically. We're building diversification within this division. We can see there that we've got the forensics department that's continued to grow year on year, corporate finance department, and obviously overseas. Combined, that's around 25% of revenue in FY21. That's up from 22% in the prior year. So we continue to diversify within this group. In terms of work wins, this is a traditional professional services business that is fueled pretty much entirely by referrals reciprocity. What we see at the bottom here is a K3 hub line. Around 7% of revenue or work wins in the period has come from this new source. As we invest in the K3 hub and expand that referral base, we would expect to see more work wins through this that stream.
Okay, so quite clearly an impressive set of numbers for last year, for FY22. But as we start to look forward into FY23, the businesses, the brands have very much continued the strong momentum that we saw last year into Q1. And we have reported here in excess of 20 million of revenue and around 6.5 million of adjusted EBITDA in the period, which clearly is again a very strong quarter. If we look at the individual parts of the business, in the business sales division, we've had a very strong quarter where we've converted a lot of our transaction fee pipelines into revenue. But as I mentioned earlier, the very pleasing factor is that we've put more deals into those pipelines and have come out at the bottom. So whilst it's been an exceptionally strong quarter in terms of revenue, the pipelines that sit behind that revenue are building and currently stand at record levels. In the tax division, as we've touched on, it's a high degree of contracted and recurring revenue, so it provides a very solid foundation in terms of how we look forward. But we also have then the additive effect of increasing those client numbers and driving the volume of clients that we have through applying that data and marketing-led sales approach. And as I mentioned earlier, almost 40% increase in client numbers in the last 12 months really, I think, is a signal of intent of what is to come within that division in the future. As we look to restructuring and insolvency, this business has achieved a very solid 30% compound annual growth rate over a sustained period of time, which more recently has been achieved against the headwinds of quite a difficult insolvency market in the UK on the back of that government support. So again, as those headwinds turn to tailwinds, we expect a very positive short, medium, and even long-term future for the Quantuma brand within the K3 Group. And as I touched on earlier, Q1 sees quite a significant increase of around 30% in the number of insolvency appointments that the brand has seen. So overall, we are highly confident in continuing to deliver our organic growth story, complemented by potentially selective acquisitions as well as we move forward. And I think that 20 million of revenue and 6.5 million of EBITDA in the quarter is certainly a strong yardstick on which to measure the performance of the business. So yeah, I think that brings the slides to a close. There are some appendices in there for people to look at in their own time. And we can hopefully move to questions now.
John, Andy, thank you very much indeed for your presentation this morning. Ladies and gentlemen, please do continue to submit your questions just by using the Q&A tab that's situated on the top right-hand corner of your screen. But just while the team take a few moments to review those questions that were submitted already, I would like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. Andy, John, as you can see in the Q&A tab, we have received a number of questions throughout today's presentation. So thank you to all of those on the call for taking the time to submit their questions. And if I could just hand back to you to run through the Q&A tab to respond to those questions where it's appropriate to do so, and then I'll pick up from you at the end. Thank you.
Thank you. I think the first two I can take care of. First question from Jake D. When considering future cash flow generation, how should we think about deemed remuneration in FY23 and 24? Is it expected to drop off, or do the individuals remain employed and paid by K3C? I think quite a simple response to this, Jake. This, make no mistake, is an earn-out payment. Because it's linked to the ongoing employment of individuals, we are, I guess, forced by accounting regulations to put it as deemed remuneration as opposed to contingent consideration. This is a payment to individuals based on the shares or the sale of their shares on these businesses. However, by linking it to employment to protect the wider group, the shareholders, and to keep people aligned, this forms part of our P&L rather than being sat on our balance sheet. In terms of moving forward, every single person that's employed within the group is on a market rate salary that have performance-related bonus arrangements. We're not expecting any changes to that moving forward. When the earn-out payments are concluded, they are concluded. There should be no step changes, and we would expect, as we said, to start generating cash and beyond. I did touch on earlier that we did say that we'll be broadly cash neutral during the earn-out period. That implies that going forward we'll start to generate significant amounts of cash. If that helps. Second question from Paul L. Why did the cost of sales increase so much year on year? What represents the investment in the future, and what's the increasing underlying cost year on year? Thanks for that, Paul. I think quite clearly these costs are predominantly linked to the restructuring side of the business. for consumer. Just to point out, in the prior year, there's only 10 months of consumer in terms of the acquisition, so quite a significant increase there. But also when you factor in that our revenue in that division is up by 45%, and this is a person-intensive industry with lower margins than the rest of the group, I think it's quite clear to see that is why there's a significant increase there. Partly because the prior year was pro rata, only 10 months, and also the significant increase in revenue. And as we've touched upon, that investment into fee earners from 225 to 250 to build ahead of the curve, clearly from someone starting work to winning new appointments and then generating revenue. There is a little bit of a lead time there, but we're only bringing people into this side of our division as and when we see the need to add capacity.
Okay, we've got one then from Mazin. Unless an investor is a client of Numis, it's impossible to get hold of analyst research. Will you consider adding paid for research to appeal to private investors? Thanks for that, Mazin. I think what we've done since our switch to Numis is that we've developed the K3 Capital Group PLC website. So that now includes the forward-facing numbers from both the analysts that currently write on us. So those numbers are now available on the website, together with an investment case and some of the information that I guess you would typically see, or commentary that you would typically see within those sort of notes. It certainly is something we would consider, yes, and happy to take that conversation forward and debate that at board level, Mazin. Andy, do you want to pick up the one on headcount?
Yeah, another one from Paul L. Headcount, the increase in management by 10 and decrease in sales by 6 reflects what's internal dynamic. I think just that's effectively relating to note 9 in the accounts, with the management going from 23 to 33. Just a reminder, Paul, that in the period we made acquisitions of Knight Corporate Finance, Knight R&D and JEC, so there's some management tagged along there. We've also increased our central function, so central finance team, and also bringing the likes of a group managing director. So that's the increase there. In terms of the movements in sales, I think it's fair to say there is a split between sales and the line below that in terms of marketing administration. Clearly, we've seen quite a significant increase in the number of marketing people that we've got internally and administration. The change in sales is largely due to something we've talked about before, where historically we had teams of people, mainly in the business sales division, travelling 50,000 miles a year going out to meet people. We're still seeing the ongoing impacts of the adoption of Zoom or remote working, where fewer people can sit more appointments, which makes us far more efficient, far better for things like our ESG and such like as well. There's no impact on the dynamic. This is purely us being more efficient at what we do.
Okay, a question from Sam E. What's the plan as the cash pile you are building grows? Will it be used for special dividend, share buybacks, or acquisitions? Yeah, I mean, we've always said that certainly our business sales and our tax divisions are highly cash generative, and as Andy sort of touched on earlier, we'd already highlighted that we expected our cash to be broadly neutral over the period of the earn-out payments that were due on the original acquisitions that we made in the summer of 20, which were typically 3-year earn-out periods. And that's exactly what we're seeing with strong cash balances being retained in the business. In terms of what we would use them for, I think acquisitions clearly is an area that we are looking at and continue to look at, and absolutely it's very useful to have those sort of cash balances in place for doing that, as well as the overall surety that gives us as a board, as a team, towards the strong foundations that the business is built on. I think it's worth mentioning that the year 2 earn-out payments that were made in August for the original acquisitions that we made last year, we took the decision to pay all of those earn-outs in cash rather than paying them as a split of cash and shares, and we did that due to what we believe to be undervalued or suppressed share price that we see at the moment. So all of those earn-out payments in August were made through cash, which was about an additional approaching £2 million of cash payout. So I think using the cash effectively where we can, whether it be through acquisitions or different structures of earn-out payments, is certainly the short-term plan rather than special dividends or share buyback. Andy, do you want to cover the next one?
Yeah, another one from Paul L. Why is the impairment provision on receivables so much higher? How recoverable is it over time? Why have the past due amounts risen so much this year? Has there been a historic issue with how consumers managed or recognise these assets, and is this it washing out? I think, first of all, to tackle the last bit, no, there's not been any historic issues with how we've managed this. I think it's fair to say this division, and it does largely relate to the restructuring division in fairness, it's grown significantly in the period, and quite clearly by having some overseas quite complex cases. We have very highly prudent revenue recognition procedures within the group. That's not just in this division, it's throughout the entire group. I think it's fair to say there is no downside risk from this. Everything that we're provided for is a worst case scenario, if you like. And I think, to put it into context, to have sub £2 million impairment provision when our turnover is £70 million, we don't think is too bad. But no, I don't see any downside from there. I don't think this is anything washing out. This is just the nature of a growing restructuring division, and us wanting to, I guess, under-promise and over-deliver by making sure we are well covered if need be.
Just conscious of time, Mark, are we okay to continue?
Yes, sir. You have as long as you need.
Okay, that's fine. A question for me indeed then. Who are your major competitors in the various sectors? Where are you increasing market share, or are you just moving with the growth in SMEs? Yeah, I think it's a complex answer, Ian, but the competition is many and varied and highly fragmented, we believe, across all of our divisions. So whether it be business sales tax or restructuring, in fact, we compete with everyone from the small accounting firms through the mid-sized firms right up to the nationals and indeed the big four and international firms at times. We compete with sector specialists within each of those divisions. So whether they be specific business sales brokers, R&D tax providers, or restructuring businesses, we compete with sector-specific players as well. So we see the competition as many and varied. I don't believe that the competitive landscape is changing significantly. We've always known it that way, and we believe it will remain that way. We operate in highly competitive markets. As we showed on previous slides, we have relatively low market share. And hopefully, as we've shown in some of those slides, we are growing that market share through what I believe to be the unique way in which we face the market and acquire our clients, which hopefully we've covered off today. And I think that is absolutely proven by the organic growth rates and how those organic growth rates sit alongside many of our competitors. It's a very impressive set of numbers. Another question from Ian. Earlier in the year, you added another senior manager to work alongside you. Would you like to comment on the contribution the new member has added? Yeah, I mean, Ian has been with us now for around 6 months as Group MD, and obviously has spent a lot of time understanding and learning about the business and starting now to contribute very much to what we do. I mean, our management team, other than the management that we've brought in through the acquisitions that we've made, but our sort of core management team was the same at the start of this year as it was almost back in 2017 when we floated the business. And we've moved significantly in that time from what was a 10 million revenue business to what is now a 70 million revenue business. So Ian's appointment is all part of building out the management team, complementing the skill sets that we have as, if you like, founder managers, which is, I think, a more entrepreneurial and founder-led approach, and complementing that with somebody such as Ian, who has a more structured and corporate approach, having come from the background that he comes from, which was running a £250 million business with 1,000 staff across 35 countries. So that clearly brings with it a different skill set than I believe we have, or I have as a sort of founder entrepreneurial manager. So so far so good. Ian and I working very well together, and Ian with the rest of the board as well, and we look forward to that contribution growing over time. Just reading the next one. Yeah, another question from Mazin. Last year, you added significantly to the staff of Quantium in anticipation of the insolvency market opening up post-COVID. Will staff utilisation improve in the current year and so lead to much higher EBITDA margins for Quantium? Yeah, I mean, I guess as you invest in overseas offices, as we've talked about, as you invest in growing that headcount and that fee earner base, you clearly create a drag on margin because of the time it takes for those investments to come through to winning work, charging time, and ultimately creating revenue and profit. So the flippant and simple answer to the question is yes. I don't think necessarily they will be much higher, but we would expect over time, as those investments come to fruition, that EBITDA margin will step forward and improve. Sort of 20% has been our target that we've had in mind. I think we'd have been very close to that this year without the overseas investment. But I think that's a credit to the group and the business that we are, not just taking short-term profit, we are investing in the mid and long-term future of that particular business. But yes, we would expect margins to potentially improve over time. Another question around acquisitions here. Can you comment on the nature of the current pipeline of potential acquisitions? Are there any new verticals you are looking at? What size of acquisition could you finance without resorting to equity funding? I mean, obviously, I guess it's an obvious point that at the moment it would be probably remiss of us to utilise equity funding as we did back in 20 and 21 to fund large-scale acquisitions because of the undervalued nature of our shares at the moment, in our opinion. So therefore, I guess automatically that pushes us into looking at the smaller to mid-size end of potential acquisition targets. I wouldn't want to get into specifics. We have a number of targets on or in our sights at the moment that we're looking at. They predominantly sit around our existing divisions. But again, we continue to look and have a steady flow of potential opportunities coming across our desk. I think the key thing for us is that, as we've shown today, we are growing very strongly from an organic perspective, and that remains a key driver for us. We are not in a position that we are forced to buy anything or there's a necessity to buy anything. And our view is very much that we will buy the right thing at the right time at the right price, rather than buying for the sake of achieving growth. And in the meantime, we will concentrate very much on the organic side. So hopefully that answers the question. I guess a similar question here. What were the reasons the acquisitions you considered this year failed to complete? I mean, Scott, we are consistently looking at potential acquisition targets and choosing whether we wish to do those or not. As I think I said in the last answer there, we're not under pressure to make acquisitions because we're growing very strongly from an organic perspective. But I mean, there are numerous reasons why we walk away from acquisitions. That can be down to vendor expectations, structure, the strategic fit of the business, the culture of the people, things that come out through due diligence, etc., etc. All the normal reasons I guess you would expect. But as I say, it comes down to us wanting to buy the right businesses and not buying for the sake of engineering growth, I suppose. So I'm just trying to read these on the go. A natural question in recent months: why has the share price taken a dive despite your better than market expectations in the last 3 major RNS announcements? Question for me indeed. Very good question, Ian. And I guess the flippant answer is I wish I knew the answer to that. All I can tell you is that I firmly believe that, as I think we're displaying through the numbers, as I think we're displaying through how we communicate the growth and strength of this business to the market, that we are building something here that is performing exceptionally well, is performing ahead of its peer group, is delivering on every metric that you can measure us on, be it revenue growth, profit growth, margin, organic growth, dividend yield, or whatever. We are growing at the forefront of our peer group in our market, and therefore it is somewhat of a frustration and a sort of scratch the head moment that the share price hasn't yet caught up with that, or there's clearly a disconnect between the two. Ultimately, I can't directly change the share price. All we can do as a team is continue to build and drive forward the success and the results of the business, and hope that in due course that the market catches up with just what a quality business we have here in K3. Andy, is there anything that you've picked off there that you can give me a break for a second?
There's quite a lot of questions here. One was in respect of FX from Mark E. As you start to generate revenues from overseas offices, are you developing any policy to hedge revenue, contract assets, liabilities into GBP? Yeah, it's something that we're monitoring on an ongoing basis. Clearly, these are set-up companies that we've established over the last 12 months. Not cash positive, it's fair to say, in the first 12 months, but as they build into generating profits and cash, it is something that we closely monitor and we're looking at as part of the central finance team.
Okay. Okay, another question here. Are you still trying to grow the average size of business deals by landing a few big ones? Is this an area of opportunity, or are you purely focused on smaller deals? No, I mean, across our brands, we're focused on all deals, I guess would be the answer. So for us, it's about, in each of our businesses, trying to do more volume each year. And if we can do that volume at a higher average value and therefore fee value, then we create two drivers of growth. So within the Knightsbridge brands, it's around very much a volume and a value play. The same in KBS Corporate. What the corporate finance brand gives us and has always given us is the opportunity to bring sizable fees into the group that tend to give us the icing on the cake, to coin the phrase. As we've said many times, we don't now build that revenue into our forward-facing numbers, and that opportunity, therefore, is very much bringing upside risk to the numbers rather than downside risk to the numbers. So again, as we move forward, we will report on how that is impacting in the overall performance of the business sales division and the group as a whole.
Another one perhaps I can pick up from Simon B. Receivables now stand at circa 35% of revenues as opposed to 28.5% in the prior year. How do you see this evolving and having a target? Thanks, Simon. I think, again, this relates to the restructuring division. Clearly, we've seen significant growth in that side of the business as we've invested into the overseas offices and in headcounts. And I think, as we've spoken about during the presentation, as we take people on who then charge time, that move into work in progress, that move into debtors, there's an inevitable increase in working capital requirements. We have seen quite a significant step change this year because of the volume of people that we've added and activity. And we've talked about all the key metrics within that division. We see that levelling out. I think there's a lot more focus in terms of the KPIs. And again, the central finance team have got some new packs together that we are putting a lot of focus within that division. I would expect work in progress and debtors to level out. I certainly wouldn't expect it to continue to grow as a percentage of turnover. Whilst we don't have any targets in mind, clearly cash generation is something that we are entirely focused on. We talk about being broadly cash neutral. We can only get there if we make sure that we're fully on top of our working capital. So yeah, we would expect that to come down over a period of time.
Okay, I think, Jake, are you coming in there?
John, absolutely, and Andy as well. Thank you very much indeed for being so generous of your time there and addressing all of those questions that came in this afternoon. And of course, you will have the opportunity to review all of the questions that are submitted today and add any additional responses where it's appropriate to do so. And of course, we'll publish those back out to everyone on the call. John, perhaps before redirecting those on the call to provide you with their feedback, which I know is particularly important to yourself and the company, if I could please just ask you for a few closing comments to wrap up with, that'd be great.
Yeah, I think they would be similar to the opening comments, probably. You know, we have hopefully presented to you there a business which is growing exceptionally well and has done over now a sustained period of time since we brought these businesses together in a market that has continued to throw challenge after challenge at us in terms of the wider environment that we operate in. So to be growing at the rates that we're growing within that environment clearly is exceptionally pleasing from our point of view. And as I say, I think really underlines the quality of the brands that make up K3 Capital. And, you know, we look forward to doing more of the same. Q1, as we've touched on, has started exceptionally well. And we look forward to, again, delivering, as we often do, underperforming and over-delivering against expectation for FY23 and beyond. So thank you all for listening. There are a lot of questions on there, which we've been able to get through a small selection of. So thanks for those. We will attempt to answer all of those in the method that the guys mentioned there, and they will, as I said, be distributed to everybody. So thanks for the time. Thanks for the extra quarter of an hour, and hopefully you've found that a useful insight into the progress that we're making here at K3.
John, that's great. And Andy as well, thank you once again for taking the time to update investors today. Could I please ask investors not to close this session, as you'll now be automatically redirected for the opportunity to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of K3 Capital Group PLC, we would like to thank you for attending today's presentation. That now concludes today's session, so good afternoon to you all.